In 2018, the Federal Reserve handed down a rare and staggering punishment, a strict cap that legally barred Wells Fargo from growing its assets beyond $2 trillion. For a major bank, an asset cap is essentially financial suffocation, the first penalty of its kind in the history of the Fed. This regulatory execution stood in stark contrast to the bank's own historical identity. For over a century, this was the reliable institution that hauled the gold, funded the expansion, and helped settle the American West. The central question is how the most trusted name on the lawless frontier became the architect of the largest retail banking fraud in modern history. In the 1850s, the California gold rush created an economy overflowing with raw wealth, but entirely devoid of law, roads, or safety. Miners had gold dust, but no secure way to store it or ship it east. Henry Wells and William G. Fargo built their business on a single premise. In a landscape without law, their primary product was the sale of absolute security. They backed that security with physical force. If a Wells Fargo stagecoach was robbed, the company hired armed posses to track the thieves through the Sierra Hills. They recovered the gold, publicized the captures, and sometimes killed the outlaws outright to send a permanent message: you do not cross this bank. That reputation for reliability saved them during the Panic of 1855, when financial contagion wiped out hundreds of businesses and panicked crowds surrounded their branches demanding their deposits. Local managers stepped outside. Because the miners knew these men hunted down thieves to protect their money, the mobs dispersed without a bank run. Early Wells Fargo treated its reputation as a matter of survival. They understood that trust was the actual capital sitting on their balance sheet. Fast forward past World War I, and that original frontier business model is gone. The federal government nationalized the private express routes, leaving Wells Fargo to survive solely as a retail bank. Entering the modern era, the bank faced a harsh reality. To compete with sprawling retail giants like Bank of America, organic growth was far too slow. They needed massive scale, quickly. Through the 1980s and 90s, leadership launched an aggressive acquisition binge. They swallowed up rivals like American Trust and Crocker National, doubling their size over and over. But forcing growth eventually strained the operation. A hostile takeover of First Interstate in 1996 went disastrously wrong. Computer systems crashed, newly acquired staff were fired, and their historically sterling reputation took a severe hit. This desperate pursuit of sheer volume began to fracture the foundation of reliability they had spent an entire century building. To stabilize the ship and keep growing, Wells Fargo agreed to a $34 billion merger in 1998 with a highly profitable Midwestern bank called Norwest Corporation. Legally and culturally, it was a takeover by Norwest. The combined company kept the famous stagecoach branding, but Norwest's executives took the wheel, injecting their aggressive retail sales strategy into the company culture. This diagram breaks down their new core philosophy. Championed under future CEO John Stumpf, the strategy was called 8 is Great. The mandate was to cross-sell 8 distinct financial products, like checking accounts, credit cards, and mortgages, to every single household. But the intense pressure to hit that arbitrary number warped the system. Branch employees were handed unrealistic daily quotas and threatened with termination if they fell short. Between 2011 and 2015, the environment became a toxic pressure cooker. Desperate workers trying to save their jobs forged customer signatures and secretly transferred money to open millions of unauthorized fake accounts. The bank that once hired posses to hunt down outlaws and protect its clients was now actively robbing its own customers to satisfy Wall Street metrics. In 2016, the fake account scandal broke wide open. The revelation triggered massive regulatory fines, wiped billions off their market value, and forced CEO John Stumpf to publicly resign. The ultimate punishment arrived in early 2018. The Federal Reserve imposed that catastrophic asset cap, effectively choking off the bank's ability to lend, grow, and compete with its rivals. After internal executives failed to stop the bleeding, the board brought in an outsider, Charlie Sharp, a seasoned, detached operator known for turnarounds. Sharp initiated a brutal cleanup. He fired 55,000 employees, completely dismantled the toxic sales quotas, and forced the entire company to pivot its resources directly into compliance and risk management. Fixing a rotted culture required tearing the existing one down to the studs. It proved that scaling a business without basic ethics is corporate suicide. Finally, in June 2025, after 7 years in regulatory purgatory, the Federal Reserve lifted the cap. Wells Fargo's balance sheet surged past $2 trillion, allowing the bank to operate freely once again. The legacy of Wells Fargo demonstrates that an institution's long-term survival depends entirely on its internal culture. They survived the chaos of the 1800s by protecting their customers' assets with their lives, and nearly died because they forgot that trust is the only currency with permanent value.